This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed. Across Bloomberg platforms on this Thursday, August 6, 2026, Carol Massar along with Tim Stenivek, live here at Bloomberg headquarters in New York City. We've got a day where stocks are down, bonds are lower as well. U.S. yields ticking higher on a renewed spike in oil prices caused by escalating tensions in the Middle East and a lack of clarity on a deal to revive the Strait of Hormuz. It looks like, sounds like, maybe, I don't know, progress, but we're not really sure, are we?
Maybe. I mean, it depends on which side you want to listen to. And also, the big question remains, what does it mean for vessels that maybe were aggressive to Iran?
I don't know. I'm just going to, wait till it's signed, sealed, delivered, on my desk kind of thing. Having said that, SpaceX shares actually higher in today's
2%
session.
to the upside right now, 1.8?
Yeah.
Okay.
So what? Bring on, more than 900 million shares, over $100 billion worth of SpaceX stock.
I asked the question yesterday about what was priced in. We knew this was coming.
Yeah, that's true. That's
so
a good
not
point.
everybody's unloading right now.
But investors.
Also, if you had a lot of shares, would you wait to sell because you're like, wait a second, I think this company's worth more?
Yeah.
It was 40% higher a few weeks ago. I would want to sell shares when the stock is higher. I don't know.
Like, do you buy into the story? Do you want to stick around or at least see it tick higher and above that IPO price? Are we above the IPO price?
Oh, are we above the IPO price as we speak? No, we're at 110 right now.
Okay, so we're not.
No.
All right, so maybe you're waiting for that. Hey, we're going to have more on the trade for you in just a moment. Ahead this hour, though, the AI spend as Alphabet lures investors again to a mega bond deal with high premiums. So we're going to get into that story. Just that whole AI spend, the CapEx spend, what we need to know with our Mandeep Singh.
Well, spending money, speaking of spending money, buying, selling, buying again, the life of a hedge fund that's been in the news a lot. We're going to talk situational awareness's return to investing and where exactly that $400 million went.
Didn't they just sell to Ken Griffin?
They sold some to Ken Griffin, but they're making investments. It's still a $10 billion hedge fund.
Buying again, as we said. All right, we're going to get the deets on that. Hey, President Trump and Fed Chair Kevin Warsh, chatty, it seems. What we know about the talks between the two, what's going on, is it unusual? We've got our own Mike McKee and Enda Curran joining us for that in just a moment. And join our discussions. We love when you guys do that. Send us questions for Mike and Enda or anybody else who's coming up on the broadcast. You just have to send them to Bloomberg.com/askradio. That's again, Bloomberg.com/askradio, exclusively for Bloomberg.com subscribers and our terminal clients. And then listen in and hear them get answered. We like it.
And send all complaints to Carol. Don't forget.
I actually like your complaints.
Questions to Bloomberg.com/askradio, complaints to Carol Massar.
You always laugh at me. You're like, I can't believe you. I respond. Send them in, everybody.
All right. Charlie Pellet is standing by. He's got today's top news, business stories, and details on the trade. Hey, Charlie.
Well, hello there, Tim and Carol. Here's what's going on. Happy Thursday, by the way. Jobs Friday coming up tomorrow morning, 8:30 a.m. Wall Street time. Right now, we do have stocks moving lower. Oil is higher. People keeping a close eye on developments in the Middle East. West Texas Intermediate crude now up 2.8%, up $2.14 a barrel, 77.36 where we stand. Barrel of Brent, 82.44. Brent crude up now by about 3.8%. Bottom line, oil moving higher, stocks lower. S&P at 77.09, so holding above that big number. We've got the S&P down 13, drop there of 0.2%. Speaking of big numbers, the Dow has dipped below 54,000. We're at 53,944 now, down 404 points, a decline there of 0.7%. NASDAQ down under 0.1%. NASDAQ 100 index lower by 0.3%. All of this, though, with the stocks, the Philadelphia Stock Exchange Semiconductor Index up by 1%. The 2-year currently yielding 4.24%, with the 10-year 4.66%. Your 30-year 5.21%. Gold down $2.50 the ounce, just about flat on the day at $42.44, while crude, as we mentioned, pushing higher. WTI up 2.8%, $77.31 a barrel. You guys touched on it. Lockup expiration day for SpaceX. Again, SpaceX shares, they are trading higher today, up now by 1.9%, 110.30 on SpaceX, went out the gate last month at 135. Briefly, the super majors, the super oil majors, they are all trading higher today, along with the price of crude oil. And among some of those names, ExxonMobil up 1.4%, Chevron up 1.2%, ConocoPhillips up by 0.5%. Recapping, S&P down 0.1. Carol and Tim, that is a Bloomberg Business Flash.
I got it, Charlie. Thank you so much. All right, folks. Hey, Chair Warsh, it's President Trump calling. I'm not sure it goes down like that.
I don't know. I don't think he calls him chair.
You think he calls him Kev?
I don't know. We don't know how it goes down. What we do know that is the two.
Does the Fed Chair call him Donnie?
The two are talking. I bet he calls him Mr. President.
I'm sure he calls him Mr. President. We're just having some fun.
We're going to have more fun with Bloomberg TV and radio international economist and policy correspondent Michael McKee. He joins us here in our studio. In the Bloomberg News Washington, D.C. bureau, Enda Curran, Bloomberg News senior Federal Reserve reporter. Enda, you and Josh Green reporting that President Trump has spoken by phone with Fed Chair Kevin Warsh since Warsh took the role, inquiring about forecasts, opinions. What else did you find out?
So we do know that they have spoken, as you say, on the telephone. It's been described as irregular since Chairman Warsh took up the job in May. We don't know if they have discussed monetary policy per se, but the issues here are less, and Mike will know more than I, but less that the President and Chairman have spoken on the phone per se. It's more about, of course, the lack of disclosure and the backdrop being all of the political pressure on the Fed that I think is drawing so much scrutiny and attention on this now. But as of now, our reporting does confirm that the President has called Chairman Warsh on an irregular basis since he came back to office. We don't know if they have discussed monetary policy, but certainly it's turning the heads of Fed watchers today.
And I just want to just correct myself. Josh Wingrove, not Josh Green, sharing the byline with you on that, Enda. So apologize for that.
Yeah. All right. So still a great story. I want to bring Mike into this conversation. Mike, is any of this unusual that we have a president talking with its Fed chair?
It's the frequency is unusual in recent years. It used to be that the presidents felt very comfortable calling up Fed chairs or having them come in. And probably the most egregious example was Arthur Burns under Richard Nixon, who met with him a lot. And Nixon persuaded him to go easy on the monetary policy ahead of the 72 election. But you go back to Lyndon Johnson used to drag his Fed officials down to the LBJ Ranch down in Texas. So it's not completely unusual, but it hasn't been the practice of presidents in recent years. They meet irregularly with the Fed chair every once in a while. I think Jay Powell met with President Trump once and with President Biden once, and that's basically it.
What is, Mike, if we think back to Fed Chair Jay Powell, at least in his first term before he faced the ire of President Trump in the first term, there was a honeymoon period because President Trump did actually appoint Jay Powell in his first term. Then he was reappointed by President Biden a few years later. What was the honeymoon period that existed from when he thought he was out of central casting until he thought he wasn't lowering rates fast enough?
It was when the Fed was at that point raising interest rates. It was 2019, of course, when we had the taper tantrum, the taper tantrum 2, when the money markets were seizing up. And so the president was not happy at that point and stayed unhappy with Jay Powell.
And to come on back in, is it just that what do we know about what they've been talking about? Like, is it the president reaching out on a variety of topics? Is it just exclusively monetary policy, or we don't necessarily know the specifics?
Well, we don't know too many specifics. I mean, we've had some generalities on the topics, but we haven't been told it's on monetary policy, to be clear on that. But of course, we know the president's view on monetary policy already. I mean, he has now, since he came back to office, has been calling for lower interest rates, and he believes the US can have lower interest rates. We know the pressure he put on the Fed under previous chairman Jerome Powell. He has been giving current chairman Kevin Warsh somewhat more leeway, saying he trusts his judgment. But nonetheless, the real test for that will come if we get into territory whereby, let's say, inflation maybe accelerates or continues to be persistent, doesn't show signs of cooling over. We get 2 readings coming up ahead of that September meeting. If we kind of get into that territory and we have more officials talking about the need to raise rates, putting pressure on the Fed to raise rates, and then, of course, it will be interesting to see how President Trump responds then. And I'm sure that's when we really will know what he's thinking about Kevin Warsh so far.
That's why I asked about the honeymoon period.
Yeah.
Because we have some history about a honeymoon period here, and I don't know.
I don't know. I mean, should we? I mean, do most presidents give their Fed chairs, some room to kind of settle in?
Well, in public, yes, because they don't. Donald Trump's the only one who's really gone after a Fed chair in public that I can think of since Lyndon Johnson, and that wasn't as much public as it was just made knowledgeable to other people. But right now, it's obviously very public because the president was continually going after Jay Powell, and he's still commenting on Kevin Warsh. He said just the other day that Kevin Warsh is doing great, but he's got all these bad people on the committee with him. That's the problem. Is does the Fed lose credibility because they're seen as being under the president's influence? Put it that way.
But Enda, I mean, the bond market is going to do what the bond market does in any situation. And so, like, the Fed chair can say what he wants and the president can say what he wants, but bond investors are going to react to this in a certain way. And I don't know, maybe that's where the power is.
Yeah, I mean, there's going to be a sequence here. As mentioned earlier, we're going to have very important data sets coming up over the days ahead. Employment tomorrow, number one, that's going to be very important. I think the bigger story would be a downside surprise, actually. That would turn heads given the stabilization story we've had all year. Jobs tomorrow, then next week CPI, then whatever it is, 2 weeks after that, we get PCE. So those numbers are going to dictate, I think, in many ways, what the Fed officials will say in their response. And of course, that in turn will dictate how the markets respond. And all of that will build up towards Jackson Hole at the end of August, and whether Chairman Warsh uses that as an opportunity to spell out some of his economic thinking, of course, all ahead of that mid-September meeting. So, the bond market certainly has been clear in their response to the Fed chairman over the past week or so. But I think over the coming weeks now, it's back to the data in terms of a reset of this narrative in terms of where the Fed might be going next.
Though, the Fed's independence. Mike, I want to ask you, because we just said, just kind of looking at this Fed. I mean, Fed Chair Kevin Warsh is one vote. So even if he is swayed, and we're not saying that, there are the other voting members, right?
Who've not been shy about expressing their opinions.
Right.
We have the leaked comment about Chris Waller saying, why are you bothering with these committees, the task forces? We have others who've pointed out that the chairman is just one of 12 votes, and the rest of us have votes as well. And we've got at least 5 now who have come out since the meeting saying they would have preferred to raise interest rates. So it's not like he's leading the Fed in a new direction yet.
One thing I want to bring in, too, and Enda, you and Josh Wingrove write in your story, the president's public treatment of Warsh has been different. During his swearing-in ceremony, President Trump said he wants the Fed chair, quote, to be totally independent. So he does kind of gently remind, or not so gently, every once in a while, right?
Yeah, well, I mean, it wouldn't be hard for things to be at least somewhat better between the president and the Fed, given how rock bottom relations hit between Chairman Powell's Fed and the White House. So that's the starting point for this. But, as Mike was saying earlier, there's a feeling that the president is giving some leeway here to Chairman Warsh. He's letting him, set the tone, set the narrative, feel his way a little bit in all of this. But this is going to come down to the data. If the inflation data over the weeks ahead is somewhat, muted, cool, whatever term you want to use, that takes pressure off the Fed to raise rates. If it's not, then that whole narrative will be lit up again, and that's where the rubber really will hit the road.
Mike, does tomorrow's jobs number matter?
Only if we get a big negative surprise. The Fed's looking at the unemployment rate. It's not supposed to change at 4.2%. If it comes in at 4.2%, they'll say the economy is not slowing significantly. It's not a threat. So we don't need to look at rate cuts or back off of rate increases because of that. If we got a very bad job creation number and unemployment went up a little bit, then that makes it much harder to argue, even in the face of some falling inflation, that you should raise rates.
Is the unemployment rate, Mike, we were talking on our call, I'm like just thinking about the U.S. labor market because we don't have immigrants coming in. In fact, we have people leaving. And I just do wonder about the pool of workers and, is the data, it's the available workers, right, that are out there that determines all of this. So,
well, it's also demand by employers. And what we've seen is a big fall off in demand because of all the uncertainty that's gone on over the last 18 months. Companies have been just waiting to see whether they need more people. They may be running a little lean at this point, given the consumer demand has held up, but they don't want to hire and then have the president impose tariffs that will increase their costs, or if inflation is going up because of the war, people stop spending. So everybody's just been kind of sitting in place. And so the demand has been low, which is one reason you're seeing very low job creation. Mm-hmm. But according to the JOLTS numbers, there's still a lot of openings and a lot of people who would be looking for work, but right now the market is kind of frozen.
It's Mike, you remind me of a conversation that we had yesterday with Con Davis, the CEO of Byrna Technologies. They make non-lethal defense, personal defense technology. And Carol, you pushed him on this about asking him about consistency from the administration. He said, he was very clear. He's like, I want a more consistent message from this administration. I don't want as much volatility as we've seen. Enda, does that start to affect productivity because there is so much uncertainty, not just with tariff policy, but with other policies as well coming from Washington?
Well, I mean, the productivity story, it's always complicated, but it's especially complicated right now. I mean, the numbers this morning were okay. I've seen some people say that they were a little bit on the soft side, but the big story, I think, on productivity right now is how is AI diffusing through the economy, and by extension, how is that impacting productivity, which is going to be critical for the inflation story in the not so distant future. And I think right now, most people would say to you that I think productivity has increased, but that's to do with small business creation since the pandemic. Maybe other factors are playing. Maybe deregulation is part of that story that can't be stripped away completely. But I think a lot of it is to do with small business creation. But the real question mark is, how is AI going to impact that? So far, there's little evidence of it impacting the productivity data, but that's going to become a very important question in the not too distant future, and that's going to be very important for the Fed too.
Folks, just about a minute or so left here. I want to save 30 seconds for each. What is the biggest risk to the economy? We've seen energy prices tick up today, Mike. We've seen yields tick up as a result. Concerns that the Fed might have to raise rates to curb some of these higher price pressures. What is the biggest risk to the economy right now in the U.S.?
Well, I would say there are two risks. One is that the war accelerates and prices go way up, and that hurts consumer spending and businesses have to lay people off. And the other, I would say, is what's going on in the equity markets, because they are so high at this point. And money just keeps pouring in. I look at the Google debt sale today.
Yeah, 10 tranches or whatever, yeah.
And it just kind of sets you up for the feeling that when things go wrong, which they will because they inevitably do, that we could have a serious crash. And then that takes away the confidence and takes away people's desire to spend money. 30
seconds for you, Enda. Biggest risk?
I think it has to be. Yeah, I think it's inflation. Does inflation, start to accelerate and take off again? And if it does after years of stinging price hikes, then that's going to become a real problem if it becomes embedded in people's expectations for the near term.
All right, folks, thank you so much. Bloomberg TV and Radio International Economics and Global Policy Correspondent Michael McKee here in studio. Out there in our Washington, D.C. bureau, Enda Curran. He's Bloomberg News Senior Federal Reserve Reporter. Hey, still to come, we're going to talk a little bit more about Alphabet and that mega bond offering with our own Mandeep Singh. That's coming your way at 2:40. When we come back, though, situational awareness.
They're spending money.
Yeah, they are spending money. What we know when we come back to you on this Thursday. Stick around, everybody.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A turnaround for NASDAQ in the green. We're on the countdown to tomorrow morning's jobs report. Oil higher, most stocks lower. Right now we've got the S&P little change, but still down under 0.1%. Well off session lows, down now by 3 points. NASDAQ, as I mentioned, back in the green, up 15 right now. The NASDAQ Composite Index up 0.1%. Techs, though, lower. We've got NASDAQ 100 Index down 0.1%. Dow Industrials at 53,963. The Dow tumbling 382 points, down now by 0.7%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up by 1.5%. A 2-year 4.24%, 10-year 3.67%, 30-year 5.21%. Again, all ahead of the jobs report tomorrow morning, 8:30 a.m. Wall Street time, and we'll have complete coverage on Bloomberg. Right now, we've got gold flat on the day, 42.48 the ounce. Crude, a rally there, up 2.8% on WTI, 77.34 a barrel. Brent, 82.47 barrel of Brent, up by 3.8%. Lockup expiration day for the first tranche of SpaceX shares. SpaceX right now up 1.6%, just about $110 a share. You recall last month it went public at $135. Carol and Tim, that's a Bloomberg Business Flash.
All right, let's get to it. Hey, Charlie, thank you so much. This is our most read story on the Bloomberg. I was just checking. Just days after his hedge fund was on the brink of collapse, Leopold Aschenbrenner has made his return to the investment scene. He's plunked down about $400 million to back a privately held company. This is according to people familiar with the matter. Digging into it, getting the details, trying to find out more is Hema Parmar. She is Bloomberg News hedge fund reporter. She was the first to report this out. She joins us now here in our New York studio. It is amazing how just a couple of weeks ago, nobody was talking about this fund, right? Am I fair to say that? And all of a sudden, here we are. All right, in just a few days, the fund had to sell assets. Citadel's Ken Griffin bought them at a discount. Then we know those investments juiced Citadel's returns. And now Situational Awareness is buying again. WOA.
Yes, What's lot in a span of 2-3 weeks. They're back investing. So they bought a stake in a private company, investing $400 million on Monday, and that adds to about $100 million they invested in late July.
I think that's a really important distinction that you made. It's not that they're going out and as far as we know, buying tech stocks with leverage.
Right.
Which is what got them into trouble before.
Correct.
This is actually what kept them out of total trouble before, was that huge stake that they had in Anthropic. Because you can't just easily sell that. It's not mark to market every single day. It doesn't have price swings and price fluctuations. So is this a departure from what they were doing before? Is it similar to what they were doing before? Do we know if there's a difference?
Yeah, so they took off all the leverage when they paid off their margin calls with this chunk of money they got from Citadel and selling their portfolio. So, they're not levered, and they've covered their shorts. So when we look at the fund now, it's private positions and it's the remaining stock portfolio that they didn't sell off. This investment does show that they're pushing more into the private space, at least with this one investment. We've yet to see what they will continue to do in the future. But it's sizable, $500 million, and a big ticket really just days after this near collapse.
So not fair yet to say that they're moving away from long-short positions in public equities and becoming venture capitalists.
Yes, no, we don't know. We don't know.
Okay.
We don't know how much they still have in the stock book. Whatever they do have has likely rallied a great deal because there was that spike after the deal was announced in the last couple of days of July.
Yeah.
So they may still have a sizable stock book. We just don't know the split of their assets with publics and privates.
Must have been a great wedding. Or honeymoon, or quick honeymoon. We should remind everybody that in the middle of all of this, he got married.
He got married literally last weekend. And so this deal happened on the Monday. And he told investors that if they want one-on-one meetings with him Monday, Tuesday, Wednesday, then he is around to take those. So literally days after his wedding.
Maybe the honeymoon's later. I don't know.
We don't know.
I think what's also fascinating, Hema, you've been covering this, all the twists and turns. Let's go to the Citadel point, right? Ken Griffin, as you reminded us, this is something he does, coming in and buying discounted assets. And so he was there to do that. What did it do to returns at Citadel?
So the Citadel's returns for the month were about flat. They had made less than 50 basis points for the month of July. After this deal, they were up nearly 6% on the month. That is how much money, that's more than the amount of money they had made year to date. They were up like 5.6 year to date. Now they're up closer to 12, boosted by this deal that has really juiced that returns, bringing it from like less than 1% to nearly 6.
So what's this $400 million investment? What company did it go to? Because you and Ed Ludlow have been doing some digging on this.
Yes. So we don't know yet what the portfolio company is. We know that it's a company that's been backed by Sequoia in the past. We suspect that it's a sizable raise if Situational Awareness is putting $500 million. If Sequoia is involved, it would make sense that whatever the company is doing a multi-billion-dollar raise, because you wouldn't want too much risk if you were an investor. So we are still curious to figure out what company it is. Yeah, we don't know yet.
But he's active. Like, it's just,
he's active.
He's kind of a fascinating creature. Like, we've talked about how young he is, how young he was when he went to Columbia, you know, connections with SBF and also, is it OpenAI, Sam Altman? Like, it's just a fascinating creature. You have yet to talk to him?
He has, the firm has declined comment for the many times that we have.
But he does talk to people. Like, we've seen some podcasts and stuff, right? But he's kind of a quiet soul.
He's done podcasts. And sometimes we see this in the venture capital space. Firms will tend to do more of the podcast sort of narrative than necessarily like news interviews. It depends on the personality. And this firm, while it's a hedge fund, while they did long stocks and short stocks and privates, it does fit a little bit more into the venture capital space. The most of their investors are venture capital individuals, founders, potentially employees. We see the hedge fund money is not really coming from institutions, but rather some of the hedge fund founders. Like it's been reported, Dan Sondheim is an investor for Rose, who is a former Tiger Global executive. So wealthy individuals' money, but more people that have tended to lean into venture capital.
So the question about, you know, and we touched on this a little bit last week when the turmoil was happening, but the investors, the current investors in the fund, and what sort of lockups exist? Are people calling to get their money back? Like, what is the sort of reputational risk that happens in a situation like this?
No, that's a great question. So when we look at the lockup, there is a multi-year lockup. So investors are stuck for some period of time. When it comes to private investments, by definition, that stuff's illiquid. So you're in it for as long as you're in it for, the fund is in it for, and frankly, with companies like Anthropic, you kind of want to be in those positions. Keep in mind, they considered selling a lot of their privates before they got that Citadel deal. So they were willing to potentially part with these coveted Anthropic stakes in advance of getting the better deal with Citadel.
Because they might have had to, right?
Because they might have had to. It shows just they were stretching for any amount of capital quickly to meet that margin call.
It's kind of fascinating, this whole story. I mean, I know we talked about his origins. How did he start his fund? Was it just a bunch of Silicon Valley types who wanted to invest with him?
Yeah.
I mean, he was a young individual, and I'm not going to put anything against youth because there are, you know, that doesn't necessarily, young or old, doesn't necessarily guarantee one thing or the other. But I'm just curious how they came to put their faith in this individual.
No, that is another great question, especially as we've seen what has unraveled very, very quickly.
Right.
And the risks that come with a highly levered, highly concentrated investment. He started a couple years ago when he created this manifesto that was called Situational Awareness, a very long document that pontificated about AI, its future, its risks, and gathered a great deal of following. Started his hedge fund with like a few $100 million a few years back, and people started watching very closely after his manifesto. He got a lot of interest because of the thoughts he was talking about, and people started following his book. He raised a lot of money really quickly. We think this year he raised a ton of capital. Grew to $45 billion as of this month, spiraled down to $10 billion. Huge decline. And look, we've seen this story before. We've seen this story when it comes to highly levered investments, highly concentrated. The saving grace in some ways was this private book. That's why he's still $10 billion, is because you have a solid chunk of capital, and he didn't sell everything. But, you know, investors don't want to see this sort of spiraling. And we've seen a lot of other hedge fund returns come out in the past couple days. And there has been pain across other AI-focused funds, but not pain like this.
That's what kind of blows my mind. You know, I think about the initial capital that's come in that got them going and then continue to come in. I mean, you're right. Like investors don't want to see a swing like this, right? I mean, that's not the idea of a hedge fund.
It's true. It's true. You want volatility, but not crazy volatility. When you're up hundreds of percentages early in the month, that's a bit of a red flag.
Which is what who we talked to that used to work for Cliff Asness, his fund. That whole idea that when it was up 400%, that should have been a red flag to everybody.
Yes.
So we want to talk to you about some of the other hedge funds that you cover and just what performance we have thus far as we get further into the second half of the year. You said July was bruising for other tech and AI focused hedge funds. What have you found?
Yes. So Whale Rock is a big hedge fund. They are focused on AI. They are somewhat concentrated. They were down 22% for the month. They are still up like 30%, 34% for the year. So it does show the hedge funds that we're seeing that are down for the month are still up a lot for the year, for the ones that focus on AI. Co2 was down 8% for the month. It was his worst performance in over a year, still up on the year.
It's interesting too, though. You get an idea of how much exposure there is to AI, but it's hard not to, right? If you are invested in any of these big tech names, whether you like it or not, you're exposed to a lot of AI. Like you think, I was listening to something on, maybe it was Surveillance this morning, just this whole idea about, I think somebody asked an investment advisor, are your clients asking for more exposure to AI? And they're like, well, you are exposed. If you bought an index fund,
that's what we're using it as this catch-all term. But there were certain companies that Oceanbrenner and Situational Awareness were invested in that are not necessarily the hyperscalers that are associated with as being beneficiaries of AI.
There were,
and they were companies that were very volatile.
Yes. And I think when we look at like the funds that did do well, some of them are the quant funds. During the pandemic when the humans were doing really well, the quants were really struggling. And in a moment like this, we actually did see some of the quants doing well, like a Renaissance fund up more than 9% for the month, an equities fund run by computers outperforming the humans that are also doing this. So that's
taking out the emotion or whatever,
or the AI is
better
winning,
risk,
Carol.
or better risk.
That's what it could be.
So next focus for you in this, is it finding out where he's putting his money at this point?
Where he's putting his money, what he's doing next, how investors are thinking about the future of this fund. I mean, there's a lot of questions we haven't seen unraveling like this in a little while.
And investors, can they pull money quickly or no? There are rules here.
So there is a multi-year lockup. It may depend when the investor got in. If they got in very early, they might have their lockup expire sooner, but that investor might not want to leave because they're still up a lot since inception. But if you're an investor that came in later, like in the past quarter, you're in a lot of pain. You might want to get out, but you're probably locked up for a few years.
Great stuff. Thank you so much. Hema, thank you. Hema Parmar, she is Bloomberg News hedge fund reporter, as we mentioned, first to really bring this to our attention, reported out her story, the most read on the Bloomberg. When we come back, bring on the bonds.
Alphabet certainly is, and luring lots of investors with its high premiums. That's next on Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. NASDAQ back in the red, oil pushing higher, the Dow, the S&P, NASDAQ 100 index all declining. Right to the numbers with the S&P down 11 now. It's 77.12 for NASDAQ, for the S&P down 0.1%. NASDAQ is down 0.1% as well. The NASDAQ 100 index now down 0.3%. The Dow at 53,939. Right now the Dow is down 410 points, a decline there of 0.8%. Rally in oil prices sending stocks lower while lifting Treasury yields. We do have the 10-year currently yielding 4.24%, the 10-year at 4.66%, the 30-year 5.21%. Spot gold down $3 the ounce, just about flat on the day at $42.43 the ounce, but crude up 2.8%, WTI $77.30 a barrel of Brent $82.44, up by about 3.8%. Burger King's U.S. sales surged last quarter. Comparable sales jumped 8.5% in the 3 months through June 30th. Now, Burger King is part of Restaurant Brands International, which owns Tim Hortons and Popeyes. QSRs in quick service restaurant on the ticker. Shares of Restaurant Brands International down 1.5%. We also heard from Papa John's International. That stock plunging now down 17.6%. Sales shrank again. Company also cut its outlook for the remainder of the year. Coming up after the close of trading, Airbnb shares today down by 1.3%. Carol and Tim, that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So one of the stories on our radar is actually a lot on this Thursday. This was about tech companies borrowing to fund artificial intelligence investments, and investors are growing wary of the debt, with 2 of the last 3 commercial mortgage bonds funding data centers having to widen pricing to attract demand. I just feel like, I don't know, there feels like there's little things that are making us kind of look at all of what's going on. And then there's what happened today with Alphabet.
So that's a little different of a situation.
It's like, bring it on, Alphabet.
Yeah, the Alphabet drew about $115 billion of demand for its jumbo bond sale. It was looking to raise as much as $25 billion from its latest U.S. investment grade bond offering. It's a deal that tests investor appetite for AI-related debt. I think that
hungry.
test was passed with flying colors.
Yeah, it does sound like they are definitely hungry for it. Hey, let's get more on Alphabet. There's a lot going on. It's an important company to watch, as we always remind you. With us, gratefully, is Mandeep Singh. He's Bloomberg Intelligence Global Head of Technology Research. He's here in studio. Mandeep, 10-part U.S. dollar investment grade bond sale, drawing tons of demand. First of all, maybe this is stupid, but what do they need constantly all this money for?
Well, now they need it all the more because they're raising their capex for next year, and they said significant increase even though they didn't quantify. And based on our numbers, we are looking at a $300 billion capex number just for Alphabet, and it cannot be financed with their operating cash flow anymore. So they have to raise money. Yeah, they did equity financing, and now the debt financing.
Why not raise more than $25 billion if there is so much demand out there?
They could. I mean, I think they are probably going to
take advantage of it.
No, but this is not the last time they are issuing a new bond. So, and they have also issued a 100-year bond. So, to my mind, they will continue to raise.
At what cadence do you think?
I mean, the fact that they want to be very aggressive with CapEx, and it seems like compared to Microsoft, which didn't say we are looking for a significant increase, Meta said they are not raising their CapEx for 2026. So Google is the one who is coming across as more aggressive now in terms of their CapEx plans relative to the other hyperscalers. The other one who is aggressive is SpaceX.
Yeah.
But SpaceX, unlike Alphabet, doesn't have the balance sheet and the cash flow to get, oversubscription like the one that we saw with Alphabet. So that's the big difference. Alphabet can afford to do it, and they will do it. SpaceX may have a harder time in terms of raising this kind of money.
Robert Schiffman, who does credit research for Bloomberg Intelligence, he wrote about this too, and he reminded us that Alphabet has already raised about $52 billion across the U.S. and Canadian dollars, sterling, euros, Swiss francs, and yen in 2026. And then he does say the 10-tranche deal suggests issuance will remain a recurring theme. So we're probably not there yet. Is this about, I was reading, it was either the New Yorker and also maybe the Times or something, just this race, and it's not just a U.S. race, Mandeep, it's China also. Is it he who or she who overspends or outspends is going to be the leader in this industry wherever it lands? Is that what this is about?
So right now, when you look at what are the parts of this AI infrastructure build out where you can see a clear ROI, it's your cloud hosting, cloud rental, which is why I feel SpaceX made that pivot, because they can see companies, the hyperscalers, Microsoft, Amazon, Google, at the scale they were at. Now they're seeing accelerating top line growth because everyone wants to consume tokens, consume compute. So even though you're not seeing a huge ROI in terms of the application side, it's the chip makers, the memory guys, the cloud guys. Those are the companies that are actually seeing tangible acceleration to their top line growth. So why not keep doubling down, which is what Alphabet seems to be doing. And they have a vertical integration play. They do their own TPUs, their chips. They deploy their chips on their own cloud, and they're able to monetize it at a much better margin, which is why their margins are expanding relative to the other hyperscalers that have to buy NVIDIA chips.
The CapEx story is it's like we talk about it every day.
Yeah.
This is the story that it's been driving equity markets for years at this point. When do we start to talk about the actual ROI that companies that are not within the space but are adopting the technology are actually getting? Like, we get a little bit of that now, but I mean, when are we going to see this actually change the ability for Procter & Gamble to sell more toilet paper or toothpaste?
I mean, I feel a lot of that ROI around AI spend is geared towards optimizing their cost structure right now. At the back end, okay, do I really need to grow headcount in a big way to support my IT systems? Probably not. There could be a lot of optimization now that can be done using AI, using the tokens, than I wasn't able to do before.
So in other words, doing more with less.
More with less, yes. Productivity is a big part of it.
Are we seeing that play out on a wide scale yet?
I mean, coding agent is that one use case that has taken off in such a big way, and it's a big market. I mean, there's no denying the fact that everyone wants a piece of that coding agent because everyone can see software developers being more productive. I mean, if 70 to 80% of the new code is being written by AI, that is what makes the developers productive. And now they're extrapolating that to other types of knowledge work. But software development has changed completely because of AI.
I want to throw into this, and I don't know if it's significant, but I'm curious. We wanted to get your take on it. Google concentrating its AI leadership at its Mountain View, California headquarters. And our story wrote out to gain momentum in the accelerating race against Anthropic and OpenAI. Is that a significant move? Or are you hearing, like, what are you, is just Alphabet, Google all in, and they are really kind of hunkering down here?
I see it as a slight negative, the fact that they had some high-profile departures, you know, Jeff Dean,
right,
and, you know, the prior departure of Noam Shazir. Like, these are guys who have got so much credibility in their respective fields, and, you know, losing them can never be good. I mean, yes, they want to speed up their model releases. I think if there is one hole I can find in that Alphabet thesis is they've been slow to release new models. They've got everything going on the infrastructure side, chips and cloud. But when it comes to model releases, they have trailed frontier models like OpenAI and Anthropic. They don't have an equivalent of a Fable 5 or the latest ChatGPT model. So from that perspective, they have to play catch up. And I can see why they would want to, you know, shift things just to speed up that model cadence, because that's what they're being questioned upon is why is there no latest Gemini model released by this time?
Where is it? Where is it? All right. For those who missed out on this bond offering, there's going to be more, right? There's going to be more. Like,
I think so, most likely.
Don't worry. It's all coming. Thank you. As always, Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research, making sense of some of the headlines, which is the story we talk about every day.
Yeah.
The spend.
We are grateful to Mandeep for coming on with us seemingly every day. So.
It needs to be Friday. We're a little worn out. I'm just going to put it out there.
Mandeep's not worn out.
No, I don't know.
He still hangs out with us.
I don't know how he does it. I don't know. You know how we talk about making people honorary anchors? He's
Mandeep
another one of them.
He's absolutely one of them.
Stick around, everybody.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are getting ready for the last hour of trade on this Thursday. Carol Masser, Tim Stenovec live at our Bloomberg headquarters in New York City. What does that mean? It's a bit of a different trade. We are down just off our lows of this session, down when it comes to stocks, down when it comes to bond prices. S&P right now down about 12 points, not even a decline of 0.2 of a percentage point. NASDAQ 100 down about 1/3 down, about 98 points. We have seen yields move up. Again, confusion, tensions, what's going on about the U.S. war in Iran and peace movements and actions to open up further or really get the Strait of Hormuz back to where it was before this war. Energy prices have moved up. We've seen WTI up more than 3% today. And as a result, you have seen U.S. Treasury yields move up. Right now, I'm looking at a 10-year with a yield of 4.66, shorter end of the yield curve, 4.24 on that 2-year note. But that as expectations that if this is kind of the world we're living in, if this continues to persist, you're going to see the Fed probably have to raise rates sooner rather than later.
Yeah, the Fed can't bring more oil to market, though.
No, but it can certainly raise rates to slow down the economy and help kind of pull rates down. But yeah.
Well, on that, Carol, our team reporting just in the last hour that Iran will seek to bar U.S. and Israeli ships from the Strait of Hormuz and require compensation from hostile countries before they're allowed to use it. That's according to local media reports on a proposed Iran-Oman deal. And as Paul Sweeney reminds us every day, I mean, the status quo before February 28th, when the U.S. and Israel went to war with Iran, was that the Strait of Hormuz in international waters was open.
Yeah, exactly. Right. So we're waiting. So it's a story we continue to follow. I'm Carol Massar along with Tim Stanovic. Let's get, though, to some stocks on the move. Bloomberg News credit reporter Emily Grafeo is in the house joining us with stock movers. And we've got some that just reported earnings right after the close yesterday.
Yeah, there's not a lot of movement on the index level, but it was kind of hard to pick which individual movers I wanted to for this day because there were some like big double-digit moves. So let's get into them. Sandisk, I picked this one because it's down today, but it is the best performing stock in the S&P 500 year to date. So it's still up like over 400% on a 2026 basis, but it is down about 5% right now. It was down as much as 14% earlier in the day. This is a memory company, computer hardware. Their revenue forecasts missed the average analyst estimate. And I guess that was enough to cause shareholders to sell the stock. This has really been a trade that has been whipsawing over the last month, I would say.
Yeah.
The memory stocks just kind of moving around a lot. But again, still year to date, the stock is up higher, but a softer than expected guidance as well.
It's only down 5% right now.
I love it is higher year to date.
Yeah.
It's up 440% year to
insane.
date. So it's like, yeah, I think
That's why I'm saying 5% drop is like...
expectations are high.
Expectations are high. The bar is high. You can't go up forever.
And it was down at the open as much as 14%.
Yeah.
So it's bounced from those lows quite a bit.
Yeah.
Forward PE is only 6 right now.
Yeah.
Current
High
PE
bar.
is 17. I don't know. All right. From Sandisk to Datadog we go. I told you there would be dogs.
Yeah. Okay, so this is another...
It's not a real dog.
It's not a real dog.
This is a big mover. Datadog, ticker DDOG, a software company. It's down about 18% right now, erasing some $18 billion in market cap if those losses hold. Again, they had earnings, but they trailed the average analyst estimate when it came to adjusted gross margin. I always like to look at the software names because that's also like kind of along with memory. Software's been such a hot button trade this year.
I thought you were going to say you like to look at it because of the private credit beat that
I
you're
was
on
about
now.
to get there too.
Oh, okay.
Yeah. I mean, private credit has dumped so much money into software because before AI came out, we thought that, there were going to be really, really sticky and reliable revenue streams from software, and the existence of AI and the competitiveness.
The
is kind
outlook
of
numbers,
thrown
though, are
that.
strong on them. Better than estimates.
Yeah. Again, I think it's traders getting really sensitive to software and maybe finally wanting to get out.
I want to save some time for Honeywell Aerospace
Right.
because this, at last check, was among the worst performers in the S&P 500
Yeah,
today.
this is an incredible move. So Honeywell Aerospace, this was a spin-off from the larger industrial conglomerate, Honeywell, the company we all know. This ticker, HONA, it's down 22% right now. The biggest drop on record. It's the first time that they've reported earnings as this independent company. The street was not happy with this. There is a Jefferies analyst, Sheila Kayalu.
Yeah, she comes on a lot.
Okay, so her note was simply titled, bruh. Do you guys know what that means, bruh?
Yeah. Kids say it a lot.
And what she said was the first reaction from most investors is, how is an aero company growing only 4%? So they reported revenue growth. They see organic revenue growth 4% to 5%, and that was down from a previous guide of 7 to 9%. So just slashing the guidance, disappointing investors, causing some really colorful sell-side reactions.
That's a little rough, man.
Yeah.
I'm just going to say. All right. Good stuff. Sorry, I'm just like kind of sitting
You're in shock.
I'm
It's
being
a
in the
big
moment.
move.
Yeah, that's a big move to the downside. Emily Grafeo, thank you so much. Check out Stock Movers, 5-minute episodes, big winners and losers in the stock market. Find it on Apple, Spotify, or anywhere you get your podcasts. Coming up next, the close on
We got the CEO of
television.
Trex joining us.
We do.
A check on the consumer and a check on labor.